Welcome everyone. Welcome to this episode of the Market Wrap. I have with me Mr. Pankaj Pandey, and what a week! We have touched all-time high one more time after such a long period, and are standing just so close to it again. I think the Nifty closed at 26,200, that sweet spot. Uh, and there's so much to discuss for this week. We had the RBI's policy rate cut that came in. We have US trade deal talks. Everything we'll discuss with Pankaj sir. So let's start from the market outlook from the top. What does it look like?
Yeah, hi, good evening, Vishu. So what we are seeing in the market is that market is sort of consolidating for the third consecutive week and in the vicinity of all-time high levels. I think this week we started on a pretty weaker note, but I think RBI policy sort of lifted the sentiments because this week is all about rupee depreciation. I think one perspective people have started to carry in the market on rupee is that it is not necessarily suggesting weakening of the economy. And on the contrary, probably RBI also wants rupee to weaken a bit to sort of help the export-oriented sectors. And also with the perspective that see, crude oil prices are already at lower levels. So even if the imported crude oil price is slightly higher, it does not impact much of an inflation. And I think so. So overall, it does not really is not so taxing for us for the economic perspective. So from that perspective, I think this RBI policy sort of lifted the sentiments. But the good news ends there because when you look at the broader markets, the mid caps are down about 0.8 odd percent. The small cap is down about 2 odd percent. But when you look at individual stocks have taken a far more sharper cut. But yes, what we're clearly seeing is sector rotation happening. So IT, which is a sort of a beaten down sector, this week gained about 3 odd percent. We've seen profit booking in PSUs because PSUs banks had sort of done well. So some bit of a breather was required. So we have witnessed a breather there. Now, our sense is that RBI policy is going to probably lift further more upside to the market, especially on the higher side. But for that to happen, 26,300 levels needs to be taken out. That is when the overall chances of market going towards 26,800 will shape up. Otherwise, this consolidation of say 25,700 to 26,300 markets can get stuck, which is what has been happening in the past 3 weeks as well. So from that perspective, I think market needs some bit of a more sentiment improvement to sort of happen. I think that can come from a possible US trade deal. Some US trade delegation is expected to sort of meeting is expected to happen next week. So any breakthrough there can help. Then you have a Fed rate decision which is pending for next week. CPI print, I think, is expected to remain soft, and I think since the rupee psychologically has been sort of has breached the 90 level mark, so any kind of appreciation in rupee possibly can sort of revive the sentiment to some extent, and obviously FPI flows could be a trigger in that. But I think for this week, it is the RBI policy which literally saved the large caps. Somehow that did not sort of percolate into mid caps and small caps.
Right, sir. Can we delve a bit deeper into the RBI rate cut, which we have seen 25 BPS, and there have been a few more measures as well to increase liquidity. What could be the rationale for this?
So Vishu, market was divided in terms of whether we'll see a rate cut or not, because after the GDP print of 8.2 odd percent, it looked like that the economic growth is pretty strong and rate cut is not much warranted. But RBI had gone in with a repo rate cut of 25 bips to 5.25 odd percent. So RBI policy turned out to be extremely dovish for the markets. And then on top of it, there is a OMO announcement of about lakh crore, then a 3-year US dollar INR bias swap of about $5 billion. So all this to sort of inject durable liquidity into the system. So that way, RBI policy was pretty dovish. And I think what RBI is sort of thinking is that, see, while the inflation for this year is expected to be lower by at about 2 odd percent, this is the revised estimate for this financial year. Even for next year, RBI is saying is that inflation is expected to hover around 4 odd percent. And this 4% is again because of the fact that 50 bips is or 50 bips is contributed because of the higher prices of gold and silver. So if you sort of look at from a overall inflation dynamic perspective or growth perspective, RBI has room to sort of cut rates, and that is where I think things have been sort of better for the markets. On the GDP front, what RBI is saying is that for FY26, the growth rate is revised upwards to somewhere about 7.3 odd percent. The previous estimate was 6.8 odd percent. And I think even for next year also, the growth is expected to be close elevated levels to somewhere around down the line in the first half of next year. They're expecting a growth of about 6.8 odd percent. And since most of the policy announcements have been positive, we have seen 10-year bond yield sort of declining by 3 to 4 odd bips. And we have seen some impact even in equity markets as well, especially in banking stocks.
Right. And how about you said the banking stocks, BFSI sector, how is it likely to deal with this rate cut? What is the impact likely to be?
So overall, when you look at the pecking order in terms of the kind of reaction what we have seen in the markets today, so with this RBI rate cut of 25 bips, NBFCs have been the biggest beneficiaries. So which is why you would see NBFCs like say, Bajaj Finance, Shriram Finance, all of them have done very well from a pricing perspective. So for them, the cost of funds come down, and obviously it adds to their margins or better growth. Then I think when you sort of look at relatively PSU banks are slightly better placed because for PSU banks, see the repo rate linked or EBLR linked loan rates is relatively lesser. So for example, for SBI, it's about 42 odd percent compared to that a private sector bank, I think could be about 60% plus. So for private sector banks, the margin pressure is going to be there, or the margin recovery, which was expected from Q3, is going to be slightly lower. But for PSU, we have already seen Q2 being better, and with this, I think for them the margin impact or the overall margin improvement, what we're seeing is going to be relatively better. So, which is why you see the price reaction. Some of the big banks like SBI did very well from a price performance perspective. And last but not the least, I think private sector banks also did well because somewhere down the line, I think there was also ulterior fear that possibly RBI can go in for a 50 bips kind of a rate cut. I think 25 bips kind of a rate cut is relatively far more manageable scenario for private sector banks. So all in all, I think it has been positive for the entire BFSI as a pack. And I think some bit of a consolidation or cooling off is what we have seen in PSU banks, not related to RBI policy, but I think because the government said that they are not looking to increase the FDI limit, nor they are sort of looking at consolidation in the current fiscal. But I think the aspiration of the government is to create bigger banks, and which is where I think possibly the PSU bank might still sort of do relatively better because when you look at from a growth perspective, or whether you look at from an asset quality perspective, PSU banks are largely sort of on par with the private counterparts at this point in time, with a decent amount of valuation gap and relatively lesser volatility compared to private sector counterparts. But all in all, it is positive for PSU banks. Pecking order, NBFC, they'll benefit the maximum, followed by PSU banks and then private sector banks.
Right. There was another big news this week of OpenAI. It seems that it will be joining hands with TCS soon. What is this all about and what is the impact likely to be?
Oh, yes. So, Vishu, this year has not been great for IT. IT as the index is down about 14 odd percent, and largely Indian IT has been considered to be a sort of a laggard or a loser in this overall AI build-up what we have seen. So from that perspective, I think things are incrementally sort of turning positive for IT companies. I think we all know that TCS had announced a 1 gigawatt data center capacity, Hypervolt. Now there are reports that there could be a potential partnership with OpenAI, and they could be looking at leasing of nearly 500 megawatt of AI-ready data center capacity from TCS. And on top of it, they are going to jointly build agentic AI solutions. So I think this is the first time you're seeing some bit of a serious development happening on the AI front for Indian companies. Now, Indian AI overall companies can help in terms of AI model training or data residency work or industry specific GPT solutions. So I think OpenAI sort of committing in India is sort of turning a corner for the entire IT industry. That is what how we'll take it. Numbers will take some time to sort of flow. But this is again early validation of the TCS newer concept of hypervault or data center capacity, which they're looking to build. And I think early days, but should be taken as a positive. And I think one needs to be very selective in IT because the outlook still remains muted. But yes, some of the stocks like say TCS offers a 4% kind of a dividend yield. Ocoforge expected to deliver some 16 or 17% growth. A new gen again from single digit growth is expected to sort of deliver double digit kind of a growth. So one needs to be selective in IT, but things are turning around a corner for IT. But yes, pace is what we can debate, but incrementally it is positive.
Right. Another sector which has been doing pretty well is auto sector. In the past few weeks, we've seen, at least this week as well, we saw some good green candles. Any reasons to be happy?
So we had monthly sales number, but I will prefer to talk of monthly sales number from a 2 month perspective because see, last year festive season was in a different period, and this time it is in a different period. Along with that, we had a GST cut. Just to sort of better understand, so which is why we are sort of combining both the month of October and November. Now, when you look at number-wise, the PV and the CV segment clearly outperformed. Volume in this category had grown by about 20 odd percent. And I think the biggest positive surprise was medium and heavy commercial vehicle because this was one segment no one was expecting to sort of witness much of a growth. But when you look at Tata Motors, the CV volumes have grown by 18 odd percent, Ashok Leyland at about 23 odd percent. PD continues to sort of do well on the expected line. So, for example, M&M, the growth was 27 odd percent, and they've been sort of doing very well even with launches also. Tata Motors about 26 odd percent. Maruti at 16 odd percent. They have a relatively lesser proportion of utility vehicles, which is why. And I think even the EV segment is also doing well. Two-wheeler, overall, there is a sort of a mixed bag because when you look at TVS did very well, 18% kind of a growth. Eicher Motor again 17% kind of a growth. But when you look at Bajaj Auto, the growth is only 8 odd percent. So there, I think it's very selective. Tractor again, another segment which is doing very well. Overall growth rate is about 19% is the kind of growth what M&M have sort of done. So I think auto selectively, the festive season post GST cards has been pretty good. And our sense is that some momentum can still be there, but one needs to be selective because IT auto index has delivered 20% kind of a return, vis-a-vis some 7, 8 odd percent kind of a return for say Nifty. So one needs to be selective. So which is why what we are liking is say Maruti Suzuki, M&M, and Eicher Motors in the OEM space.
Another media interaction that was the town of that was the talk of the town this week was Asian Paints. There was lots. I mean, Asian Paints was under pressure for a while, and now the table seem to be turning. What are the takeaways there?
So Asian Paints, after 2 years of lull, is offering far more interactive or far more interesting insights. One, the company is saying that the competitive intensity is stabilizing, and which means that the opportunity for market leader like Asian Paints to sort of grow is sort of improving. And the company is saying that decorative side they'll continue to sort of do better than the industry. And overall, see, this company is looking to build certain segments. So one is the B2B business segment because what they're anticipating is a higher demand for real estate coming from real estate or painting and service proposition for housing societies or even industrial assets. Then I think they are expecting this business to sort of contribute 20% of the overall standalone decorative business. This is currently about 6 to 8 odd percent. So this is one area of growth for them. Then they're also looking to sort of scale up the industrial coating business, so which includes automotive and infra. This again should improve from 5% what it is at currently. Now the other thing is that in the home decor segment, they've been there for a very long period of time. So company is sort of giving another 2 years to see that if this contribution increases to 7 to 8 odd%. Otherwise, probably they'll have to take a hard call there. Some total companies guiding for a growth of about 10 odd%, and the consumption category, big name like Asian Paints growing at 10% is a good thing. EBITDA margins in the range of 18 to 20 odd%. So I think largely this double-digit growth bias is intact for next 2 3 years. Earlier we were thinking only in the H2. So from that perspective, I think Asian Paints last time we had changed our rating to buy, and we continue to maintain a buy with a target price of I think 3,330.
Right. ITC had an interesting week. We had multiple events happening for ITC. We had some bills being passed in Lok Sabha, which are likely to impact its business, of course. And then there was news about BAT selling its stake as well in ITC Hotels. What is the overall outlook on this on these two stocks?
So ITC, we talk more when there is some legislation happens. So I think post GST, since the highest rate for GST was 40%, and the overall taxation in the say cigarette segment is in the range of say 50 to 55 odd%. So there was some expectation that probably the rates might come down, but I think government was very categorical in the first instance that the overall tax incidence is not going to come down. So GST at 40% remains. Then whatever cess and other duties were there, those are going to get replaced or renamed in the name of excise duty. So overall tax incidence on cigarettes is not going to come down. Now, on the other say product like say tobacco or zarda or other products, I think what the government has done is that they've introduced a new cess. So the GST sort of remains, but I think the balance component of the taxation gets sort of replaced by a cess. So net, we are not expecting major or no changes on the taxation front. And with that in perspective, nothing changes for ITC. I think one can draw comfort that a big change, which could have implication, is a sort of a non-event for them. Now, for ITC, I think we have clearly seen that one of their parent BAT has been sort of selling stake in ITC also, and they are looking to sell in ITC hotels also. So in ITC hotel, they've sold about 8 odd% kind of a stake at a price of 205. So since the price is currently at similar levels, so a bit of a hangover is over for the stock. Eventually, BAT is expected to sort of completely exit. So from that perspective, we would expect it is a bit of a overhang sort of getting or lesser of a overhang going forward. So from that perspective, nothing changes, but taxation being a non-event for ITC is a relative positive.
Right. And how about Sun Pharma? It has announced some mega investment plans, is the news.
So, why it is sort of probably making some headlines, or why we are sort of looking this announcement more interestingly, is that when we look at Indian pharma companies, typically their capex announcement hovers around, say, for capturing growth markets or export markets like US and Europe. I think this is the first time we are seeing a big pharma company announcing a capex of 3,000 odd crores for domestic formulations. So, for example, just to give an example, Sun Pharma for itself has invested about 20,000 odd crores in the last 10 years. And this is entirely for markets like US and other export markets. I think domestic markets, pharma companies have ignored for a long period of time because somewhere down the line, the export market looked very lucrative. Now, in export market, things are sort of challenging, especially for US market on the generic side. So with that in perspective, the domestic market looks attractive, that here you can grow at 8 to 10 odd%. Your asset turnover is somewhere about 3 times. So which is why this entire segment has been overlooked. And some of the companies like Torrent Pharma have done very well. So they are largely domestic oriented. The other factor which is going to drive is that, see, off late, or there has been some bad publicity about Indian pharma on the global side because of the quality issue. So with that in perspective, the government is implementing Schedule M, so which mandates stricter manufacturing norms, which means that the entire or long tail of manufacturers on the pharma side, they might sort of have to face a lot more scrutiny, and which again opens an opportunity for bigger players which can produce quality generic drugs. So with that in perspective, we see this as a very interesting thing. And if this announcement is followed by other players, then I think tide is definitely turning for the domestic pharma industry. And on Sun Pharma specifically, we carry a very positive view with a target price of 1965.
Right. There was another balance sheet maneuver that happened in the steel sector with JSW selling its one of its BSPL to its partner. What is it all about? What is the purpose of this activity?
So JFE has been a very long-term partner for JSW Steel. They have been holding about 14-15% kind of a stake in the company. But JFE wants furthermore, so which is why what has happened is that JSW Steel had acquired Bhushan Power and Steel during the IBC. And so from that perspective, this was a plant which was carrying a capacity of some 4.5 million tons. Now, this plant will be parked in a separate JV where 50% is going to be held by JFE and the balance by JSW. In that process, JFE is going to put about 15,000 odd crores. Effectively, the enterprise value of this business is coming at 53,000 odd crores. So, in fact, valuation-wise, it's quite a good deal for JSW because typically we value JSW Steel at 9.5 times. So this deal at this valuation, it is valued at somewhere about 12 odd times. And the perspective is to sort of scale this business further up to say from 4.5 million tons to 10 million tons and probably longer. So for JSW, the effective target prices target price goes up by about 60 odd rupees. But since the prices have already rallied, so we continue to sort of maintain a hold. But JFE can bring a lot more technology-oriented product. A lot of alloy manufacturing can happen. We see a lot of combination of various alloys. So from that perspective, this can be an interesting development and can be a lot more bigger in size going forward. And JSW has benefited a lot in partnership with the JFE. So I think probably this also is expected to be a good partnership in the making.
Right. And finally, coming to the hidden gem of the week, which will it be this time?
So we show RBI has cut rates, so interest rate sensitive sectors are expected to do well. BFSI has done well in pockets. Real estate is one segment which hasn't done well from a price performance perspective. So Mahindra Lifespace is what I would recommend with a target price of 550. Now, Mahindra as a group has been sort of doing well. They consider this company as one of their growth gems. This company has done about 53 million square feet of residential projects across many cities, plus integrated city development and industrial clusters. The reason for liking is that the company is, done a pipeline building of new business development of nearly 32,000 odd crores in the last, say, 1.5 years, and which is 3x the kind of number what they would have done in a period of, say, 2017 to 23. So overall gross development value is about 46,000 odd crores for this company. The other is that this company ventured into affordable housing, and it is very difficult to make money, say 25-30% kind of a margin in affordable housing. So companies struggle there. Hopefully they'll be exiting or they'll completely exit this by FY29. The other is that on the pre-sale side, the company is guiding for pre-sales of nearly about 10,000 odd crores, 9,500 odd crores is going to come from the residential side. Currently, that number is about 2,800 odd crores. So you're roughly looking at a 30-35% kind of a growth there. Debt was also a challenge for the issue. So recently, the company had raised money through rights issue. So they raised somewhere about 1,500 odd crores. So now they are carrying a net surplus of somewhere about 450 odd crores. Earlier, they were carrying a debt of 730 odd crores. And whatever land they have acquired, they need to sort of do a staggered payment of 11,500 crores over the period of time, which we believe that for that they don't need to finance or because they'll have a decent amount of internal cash flow generation. So, and this is one of the few companies which is trading below NAV. So which is why we have given a 25% premium to NAV with a target price of 550. So hopefully, interest rate sensitive sectors should do well from here on post RBI cut.
Absolutely. Well, that was it for this time. Thank you so much, sir, for your insights, and thank you so much, everyone, for watching. If you have any questions, please put them in the comments, and we'll try to get back. Thanks again.
Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.